Stop whatever you're doing for a moment, because what happened in the Middle East this week is about to show up somewhere much closer to home, not on a battlefield, not in a diplomatic meeting, in your bank account. Wednesday afternoon, Washington time, global oil traders began reacting to a series of military escalations between Israel and Iran that analysts had warned about for years, but markets had largely ignored. Within hours, crude prices surged, shipping insurance rates spiked across the Persian Gulf, and equity markets around the world erased hundreds of billions of dollars in value. Not gradually, not calmly, violently. When markets open Monday morning in the United States, millions of Americans will discover something important about modern geopolitics that rarely appears in history books. Wars in distant regions do not stay distant anymore. They move through supply chains, energy markets, bond yields, and consumer prices, until eventually they arrive in the most personal place possible, your wallet. Because the Israel-Iran war is not just a regional conflict. It is an economic shock moving through one of the most fragile parts of the global system. Energy. And energy shocks have a pattern. Stay with me, because by the end of this video, you will understand the three-stage economic chain reaction that turns Middle Eastern wars into financial pain for ordinary Americans. A pattern that has repeated itself during nearly every major oil crisis of the last 50 years. A pattern that is activating again right now. Stage one is disruption. The Middle East still sits on a massive share of the world's oil infrastructure. Iran alone holds some of the largest proven reserves on Earth, and the waters around it include the Strait of Hormuz, a narrow shipping corridor through which roughly a fifth of global oil shipments pass every day. When tensions escalate in that region, energy traders do not wait for physical shortages to appear. They price and risk immediately. Tankers demand higher insurance premiums. Shipping companies reroute vessels. Energy firms hedge against supply interruptions. And traders bid oil prices higher in anticipation of possible disruptions. That process began almost instantly after the latest escalation between Israel and Iran. Within hours, crude futures jumped sharply. Energy analysts began warning that even a small disruption in shipping through the Persian Gulf could send prices significantly higher. Not because supply has disappeared yet, but because markets fear that it might. Fear moves faster than tankers. Check the historical record and you will see the same pattern repeatedly. 1973, the Arab oil embargo sends prices skyrocketing and pushes the United States into recession. 1974, the Iranian Revolution disrupts oil markets and inflation explodes. 1975, Iraq invades Kuwait, and energy prices surge overnight. Each time the mechanism begins the same way. Disruption. But disruption alone does not crash economies. That requires stage two, transmission. Energy prices flow through the global economy like electricity through a circuit. When oil becomes more expensive, transportation costs rise. When transportation costs rise, companies raise prices. When prices rise, consumers spend less on everything else. Suddenly, the shock that began with tankers in the Persian Gulf starts appearing in grocery stores, airline tickets, shipping invoices, and electricity bills. And the United States is particularly sensitive to this chain reaction. Americans drive more than most populations on Earth. The U.S. economy moves enormous volumes of goods by truck. Air travel connects thousands of cities across the country. All of that runs on fuel. So when energy prices surge, the cost structure of the entire economy shifts upward. Airlines pay more for jet fuel, delivery companies pay more for diesel, manufacturers pay more to move raw materials, retailers pay more to stock shelves. Those costs eventually land in the same place every time. Consumers, which brings us to stage three, financial reaction. Investors understand the energy transmission effect very well. They know that rising oil prices tend to increase inflation while simultaneously slowing economic growth. That combination is dangerous. Higher inflation forces central banks to keep interest rates elevated. Higher rates slow borrowing, housing, and business investment. Meanwhile, expensive fuel reduces disposable income for households. When those pressures arrive together, markets begin preparing for slower growth or even recession. That preparation is what we have already started to see. Stock indexes reacting sharply to energy headlines, airline shares falling on fuel cost concerns, transportation stocks weakening, investors shifting toward defensive sectors and commodities. Not because a recession has already arrived, but because markets price future risk long before it becomes visible in official data. And wars near major energy corridors represent one of the fastest ways to introduce that risk, which means the story unfolding between Israel and Iran is not just a geopolitical confrontation. It is a financial event, a shock traveling through the arteries of the global economy, oil markets first, then supply chains, then prices, then markets, and eventually households. In the next part of this video, we are going to follow that shock step by step through the American economy and show exactly how a conflict thousands of miles away can translate into higher gasoline prices, falling stock portfolios, and a slowdown that millions of Americans will feel in everyday life, because the war itself is only the beginning. The real economic consequences are just starting to move. Look carefully at what is happening in energy markets right now, because the numbers themselves tell a story that most headlines still miss. When traders believe a geopolitical crisis might interrupt oil supply, they do not wait for tankers to stop moving. They begin adjusting prices immediately. Futures contracts move first. Insurance markets react second. Shipping routes change third. Physical shortages come last. Right now, we are still in the first phase of that chain reaction. Prices are moving faster than barrels. Energy traders call this the risk premium. It is the extra cost markets attached to oil when there is a possibility that supply might suddenly disappear. The premium can rise extremely quickly when the world believes a critical shipping corridor could be disrupted. And the corridor everyone is watching is the Strait of Hormuz. Look at a map of global oil traffic, and the reason becomes obvious. The Strait of Hormuz is only about 20 miles wide at its narrowest navigational channel. Yet an enormous portion of the world's energy supply moves through it every single day. Tankers leaving the Persian Gulf must pass through that narrow waterway before they can reach global markets. Now consider the strategic reality created by the Israel-Iran conflict. Iran sits directly on that corridor. If tensions escalate, even limited naval harassment, drone activity, or missile threats near the shipping lanes can dramatically increase the perceived risk of moving oil through the region. Insurance costs surge, tanker operators slow traffic. Some companies temporarily pause shipments until the situation becomes clearer. And the moment that hesitation appears, traders begin bidding oil prices higher, because even a small reduction in shipments can ripple through a tightly balanced global market. Energy supply and demand operate on thin margins. A disruption of only a few million barrels per day can push prices sharply upward, especially if the disruption appears unpredictable or prolonged. This is where the financial impact begins moving closer to the United States. America no longer imports most of its oil from the Persian Gulf, but the global price of oil still determines the price Americans pay for fuel. Oil is traded on a global market, which means a supply shock anywhere affects prices everywhere. If global oil benchmarks rise, U.S. gasoline prices tend to follow, sometimes quickly, sometimes within days. And gasoline prices carry enormous psychological and economic weight inside the American economy. When consumers see fuel costs rising at the pump, they immediately begin adjusting behavior. Vacations get postponed, driving trips shrink, spending tightens across a wide range of everyday purchases. Retail sales soften. Travel demand weakens. Transportation companies raise fees. Delivery services increase surcharges. Slowly but steadily, a war thousands of miles away begins rewriting household budgets across the United States. But the transmission does not stop with consumers. Corporate America feels it as well. Consider the industries most exposed to rising fuel costs. Airlines operate on thin profit margins, even during stable energy markets. Jet fuel is one of their largest expenses. When crude prices rise sharply, airline operating costs climb almost immediately. That forces difficult decisions. Ticket prices go up, flight schedules shrink, profit forecasts fall. Investors respond quickly to those changes, which is why airline stocks often drop early in an energy shock. Transportation companies face a similar challenge. Trucking fleets consume enormous volumes of diesel fuel. Logistics networks rely on predictable transportation costs to maintain efficient supply chains. When fuel prices spike, delivery costs increase across the entire distribution system. The result shows up everywhere. Online shipping fees, grocery distribution costs, construction material transport. Even the price of moving food from farms to supermarkets begins creeping upward. And because energy sits near the foundation of modern production, the shock spreads further. Manufacturers see higher input costs. Farmers see higher fertilizer and fuel expenses. Factories pay more to operate machinery and transport goods. One increase triggers another. This is how inflationary pressure builds during energy crises. The central bank watches these developments carefully because rising oil prices can complicate monetary policy decisions. If inflation begins accelerating again, interest rates may stay higher for longer than investors previously expected. And that possibility is exactly what financial markets have started reacting to. Bond yields adjust. Equity valuations come under pressure. Growth stocks weaken. Investors rotate capital towards sectors that historically perform better during commodity-driven inflation cycles. Energy companies, commodity producers, defensive industries with stable demand. The pattern is familiar to anyone who has studied previous oil shocks, but the current situation contains an additional complication that markets are still trying to measure. Duration. Short geopolitical crises often trigger brief spikes in oil prices, followed by rapid declines once tensions ease. Markets recover quickly if traders believe the disruption will be temporary. But prolonged conflicts near strategic energy corridors create a very different outcome. Uncertainty becomes persistent. Shipping risk remains elevated. Energy traders maintain a long-term risk premium on oil. That scenario creates sustained pressure on transportation costs, consumer prices, and economic growth. which is why analysts across Wall Street have begun asking a simple question. Not whether the Israel-Iran conflict can move markets, but how long the shock might last. Because the longer uncertainty remains embedded in global energy supply, the deeper the economic consequences become. And that is where the next stage of the story begins. Markets are not just reacting to rising oil prices, they are trying to anticipate what happens if the instability spreads beyond energy and into the broader financial system. And history shows that once an energy shock collides with fragile economic conditions, the consequences can accelerate much faster than most people expect, which is exactly what we are going to examine next. Watch the markets closely during moments like this, because the first signals of economic stress rarely appear where most people expect them. They appear in expectations. Not the price of gasoline today, not the price of groceries tomorrow, but the price of risk weeks or months from now. Financial markets constantly attempt to forecast the future, and when energy shocks begin colliding with geopolitical instability, that forecasting mechanism becomes extremely sensitive. Investors begin asking a different question, not how expensive oil is today, but what sustained high energy costs could mean for the entire economic system. Because the modern economy runs on expectations just as much as it runs on fuel. Companies make investment decisions based on what they believe demand will look like next year. Banks lend money based on their confidence that borrowers will remain financially stable. Consumers spend money when they feel secure about their income and savings. When uncertainty spreads through energy markets, it slowly begins infecting all of those decisions. This is where the financial transmission mechanism becomes more complicated. Higher oil prices do not automatically create a recession, but higher oil prices combined with uncertainty can. That distinction matters. History provides several examples of how the process unfolds. During the oil crisis of the 1970s, energy prices surged dramatically after geopolitical conflict disrupted supply from the Middle East. Inflation climbed, interest rates followed, and economic growth slowed across much of the industrialized world. The pattern repeated again during the early 1990s, when Iraq's invasion of Kuwait triggered another sudden spike in oil prices. Markets reacted quickly, investors reassessed growth forecasts, and economic momentum weakened. The reason these events mattered so much is simple. Energy sits near the base of the economic pyramid. When energy becomes expensive, almost everything above it becomes more expensive as well. Transportation, manufacturing, agriculture, construction, retail, logistics. Every layer of the economy depends on the one below it. So when the foundation shifts, pressure builds upward through the system. Now consider the environment in which the Israel-Iran conflict is unfolding. Global markets were already navigating elevated interest rates, lingering inflation concerns, and geopolitical tensions across multiple regions. That means the system was not perfectly stable even before energy prices began reacting to events in the Middle East, which is why investors started adjusting portfolios almost immediately after the latest escalation. You can see the repositioning if you examine sector performance during recent market sessions. Energy producers gaining value. Defense contractors attracting new investment, commodity-linked industries strengthening. At the same time, sectors that depend heavily on consumer spending or stable transportation costs begin facing pressure. Airlines, retail chains, travel companies, manufacturers with complex global supply chains. This shift does not necessarily mean a crash is guaranteed, but it signals that investors are preparing for a scenario where energy-driven inflation persists longer than previously expected. And when expectations change, financial conditions change with them. Higher energy costs can reduce corporate profit margins. Higher transportation expenses can weaken global trade activity. Higher consumer fuel bills can reduce discretionary spending. One by one, each of those pressures chips away at economic momentum, slowly at first, then sometimes suddenly. Another place where analysts watch closely during energy shocks is the bond market. Government bond yields reflect the collective expectations of millions of investors regarding inflation, economic growth, and monetary policy. When traders believe energy prices could keep inflation elevated, bond markets begin adjusting. Those adjustments matter because higher yields increase borrowing costs across the economy. Mortgages become more expensive, corporate loans become more expensive, credit card interest rates remain elevated, housing demand cools, business investment slows. Even companies with healthy balance sheets begin reconsidering expansion plans when financing becomes more costly. Once again, the transmission mechanism continues moving forward. Energy shock, inflation pressure, interest rate expectations, financial tightening, economic slowdown. Each stage amplifies the next. This is why financial markets often react so quickly to geopolitical conflict near energy infrastructure. Investors understand that once the chain reaction begins, reversing it can take time, and time is exactly what markets are trying to estimate right now. How long will the Israel-Iran confrontation remain unstable? Will tensions cool within weeks, allowing oil prices to retreat? Or will the region experience a prolonged period of military standoffs, naval patrols, and supply uncertainty? Those two scenarios produce dramatically different outcomes for the global economy. A short disruption may cause only temporary volatility. A prolonged disruption could force businesses and consumers to adjust to higher energy costs for months or even years, which is why the next signals markets watch will not come from stock exchanges alone. They will come from shipping data, energy inventories, diplomatic negotiations, and the behavior of the world's largest oil producers. Because if global supply begins tightening while geopolitical risk remains elevated, the financial story surrounding the Israel-Iran conflict could shift from a temporary shock to something far more consequential. And when that shift happens, the effects will begin appearing in places far beyond oil markets: credit conditions, consumer confidence, corporate earnings, eventually even employment. The process rarely happens all at once. It unfolds step by step as each economic layer absorbs the pressure from the one below it. Which means the next stage of the story is not about what has already happened in markets. It is about what could happen next if the energy shock continues spreading through the financial system. And that possibility is what analysts, policymakers, and investors are now watching extremely carefully. Now, step back and look at the full chain reaction forming across the global economy. Because the real financial impact of the Israel-Iran war is not contained in a single headline or a single trading day. It is a sequence, and sequences matter. The sequence begins with geopolitical shock. Military escalation between two regional powers immediately raises the perceived risk surrounding energy infrastructure and shipping routes. Traders respond by pushing oil prices higher to reflect the possibility that supply could tighten. That is the first movement. The second movement arrives when higher energy prices begin filtering through transportation networks and production costs. Companies that rely on fuel suddenly face higher operating expenses. Airlines, trucking fleets, shipping companies, manufacturers, and agricultural producers all see margins begin to compress. Some businesses absorb those costs for a short time. Most eventually pass them forward, which leads directly to the third movement: consumer prices. Gasoline becomes more expensive, shipping costs appear on online purchases, airline tickets climb, food distribution becomes more costly. The pressure may start slowly, but it spreads across everyday spending categories that millions of Americans encounter every week. And when households begin paying more for essentials, something predictable happens. They cut back elsewhere. Dining out declines, travel plans shrink, retail spending softens. Major purchases get delayed. This behavioral shift is subtle at first, but it carries enormous economic consequences because consumer spending represents a large portion of the American economy. When millions of households simultaneously begin tightening budgets, corporate revenues start weakening across a wide range of industries. That is when the fourth movement begins. Financial markets adjust. Investors analyze earnings expectations and revise them downward for sectors exposed to rising costs and slowing demand. Stock prices begin reflecting those new forecasts. Some industries fall quickly. Airlines struggle with fuel expenses. Retailers face cautious consumers. Transportation firms deal with rising logistics costs. Meanwhile, other sectors move in the opposite direction. Energy producers benefit from higher oil prices. Commodity companies see stronger demand. Defense contractors attract new government spending as geopolitical tensions remain elevated. Markets rarely fall evenly during energy shocks. They rotate. Capital moves away from vulnerable sectors and toward industries that benefit from the new environment. But even with that rotation, broad market volatility often increases because uncertainty itself becomes a major economic force. Businesses delay investment decisions. Consumers hesitate before making large purchases. Financial institutions tighten lending standards to manage risk. Slowly, the momentum of the economy begins to change direction. This is the stage where policymakers start paying close attention. Central banks monitor inflation data. Government agencies track consumer confidence. Energy officials watch global supply levels and shipping activity. Because if the shock persists long enough, it can begin shaping monetary policy decisions and economic forecasts. And that is exactly why the conflict between Israel and Iran matters far beyond the region where it began. The world's financial system is deeply interconnected. Energy prices influence transportation costs. Transportation costs influence consumer prices. Consumer prices influence inflation expectations. Inflation expectations influence interest rates. Interest rates influence investment, housing, and employment. One disruption near a critical energy corridor can therefore ripple outward until it touches nearly every corner of the global economy. Which brings the story back to the central point. The Israel-Iran war is not only a geopolitical confrontation, it is an economic event unfolding in real time. The market reactions already visible represent the early stages of a process that has appeared repeatedly throughout modern financial history. Whenever instability emerges near major oil supply routes, the financial consequences eventually spread far beyond the original conflict. Sometimes the shock fades quickly. Diplomatic agreements reduce tensions, shipping routes stabilize, risk premiums remain embedded in energy prices. Businesses and consumers adapt to a more expensive operating environment. That second scenario is the one investors are now trying to evaluate, not because the outcome is predetermined, but because financial markets must prepare for multiple possibilities at the same time, which is why analysts, traders, and policymakers are watching several signals very closely in the weeks ahead. Energy prices and shipping activity in the Persian Gulf, consumer spending patterns inside the United States. Each of those indicators provides clues about whether the shock will fade or intensify, because the speed of the financial transmission mechanism depends heavily on duration. Short disruptions create volatility. Long disruptions reshape economic expectations. That distinction matters for investors, businesses, and households alike. The truth is that wars today rarely stay confined to the battlefield. They travel through supply chains, markets, and financial systems with extraordinary speed. A missile launch can move energy prices. Energy prices can move inflation expectations. Inflation expectations can move interest rates. And interest rates can move the savings, investments, and purchasing power of millions of people who live thousands of miles away from the original conflict. That is the economic reality of globalization, which is why a conflict unfolding between Israel and Iran can eventually influence something as ordinary as the price Americans pay for gasoline, groceries, travel, and household goods. Not instantly, but step by step through the economic chain reaction we have just traced. Understanding that sequence matters because financial shocks rarely appear without warning. The signals emerge gradually through markets, energy prices, and shifting expectations. The question now is not whether the Israel-Iran conflict can move markets. We have already seen that happen. The real question is how long the uncertainty surrounding global energy supply will remain part of the economic landscape. Because the longer that uncertainty persists, the more likely it becomes that the shock will continue working its way through the system, from oil markets to supply chains, to prices, to financial markets, and eventually to household budgets across the United States. That is how distant conflicts become personal economic events. And it is why investors, businesses, and policymakers around the world are watching the developments between Israel and Iran so closely right now. The battlefield may be thousands of miles away, but the financial consequences travel much farther.